All right, now in this particular set of facts, we want to have an understanding about whether something qualifies as a qualified stock option plan where you can defer the income until ultimately you sell the stock. So you have no tax when it was granted, no tax when it was exercised, all the tax, capital gain, when you sell it. Or if it's a non-qualified plan where some of the income will be taxed immediately and then the balance when you sell it. So we want to understand how that's being done. And we're going to take a look at Bill Banks, who has issued some stock, and we're going to be the accountant who has to make some decisions. So let's take a look at these facts together. Let's make the assumption that Bill was granted the options to purchase 100 shares of Money Company stock for $10 per share. The stock options were granted on January 1 of year one when the Money Company stock was trading at $8. So note, the stock option is at higher than the actual market value of the stock. Now imagine that it's 2005 and you're the senior accountant and you've been given the task of confirming whether the stock option that was issued was qualified or non-qualified so that you can determine the tax consequences for Bill in his tax year when Bill exercises the options. By the way, the fair value is now at $15 a share. So we need to go back to the future. And next, we're going to take a look right here and we say, all right, going back to the future, you peer into a meeting that took place way back on June 30th of year zero between the internal auditor and the CFO of Money Company. Let's listen to their conversation. The internal auditor, excuse me, may I ask you a few questions about the employee stock plan given to Bill Banks? The CFO, sure. What do you need to know? Well, the internal auditor says, first, did the shareholders approve the plan to offer the stock options to Bill? The CFO, of course. The stockholders approved the plan that detailed the total number of shares that may be issued and who was to receive those options. Bill was just one of the employees to receive the employee stock plan. The internal auditor, oh, okay, great. When was this plan approved? The CFO, at our annual meeting. Also, the options are required to be exercised within the next 5 years. The internal auditor, does Bill own more than 10% of the money stock plan? CFO, no. None of the employees owns more than 10% of the stock in Money Company. The Money Company also does not have a parent company or any subs. You may need to know that as well. The internal auditor, oh, thanks for your time. Well, it sounds like the stock was issued as a qualified stock option to me because of the following. 1, the option was granted under a plan approved by the stockholders. 2, the option was granted within 10 years of the date when the plan was approved or approved in. And then the options were exercisable within 10 years. Bill did not own more than 10% of the combined voting power of the corporation, parent, or sub. So I think that they are qualified stock options. The CFO, well, that was our intent when we issued them. So I'm glad you came to the same conclusion. Thanks for your hard work. As you can see in this example, the auditor went through all of the various questions that are prerequisites in order for the plan to qualify as a qualified stock option plan. And once it does, the employees are very happy because why? The employees don't pick up any income on the grant date. They don't pick up any income on the exercise date. All of the income is capital gain upon the sale. And that's a much better solution than a non-qualified plan, isn't it? So this is a great way of making sure you understood all of the qualifications for the plan, just in case the examiners decide to test you on that. Hopefully this helped you master that one. And with that, you're now an expert in this area, and we're ready to move on.